Dividend Aristocrats and Kings, the aristocracy, the royalty, the cream of the crop of dividend companies. Wave after wave of new investors are lured to the riches these companies will produce for them. And yet, time and time again, they have been unpleasantly surprised by a lackluster performance and even the unthinkable, the falling of these companies from their throne. In this video, I will explore what the big problem with the Dividend Aristocrats and Kings is, how to avoid falling into their trap, and what you can do instead if you want to have a growing and compounding passive income in the form of dividends. Alright, for those who are newer to the game, let me just briefly describe what these companies are before moving on. The Dividend Aristocrats are members of the S&P 500 that have paid an increasing dividend for at least 25 years. The Dividend Kings must have done this for at least 50 years, but they don't need to be members of the S&P 500. So let's investigate why investors, especially new ones, love them. If you think about it, it's not that hard to see. I mean, being able to not only pay a dividend, but also a growing one for decades and decades is not an easy achievement. First, it shows that the management is good at planning their cash flows and has financial foresight, otherwise they wouldn't have been able to always have enough money to pay all their shareholders. Second, being able to always pay consistent and rising dividend means the business is very stable and can generate enough cash through the ups and downs of the economic cycles and recessions. This, of course, shows the high quality of the company. So with all these traits, you can see why new investors who are interested in dividends would be attracted to these types of companies. Besides, they make for an easy marketing campaign as well. They have this fancy name of aristocrats or kings, signaling prestige and quality, right? I mean, I won't lie, the Dividend Aristocrats were literally the first thing I learned about dividends years ago when I started investing. I was so pumped to get into these types of companies and have my dividends grow and compound forever. As my investing knowledge increased, however, I found out that it's not all sunshine and rainbows in the kingdom of the aristocrats and the kings. In fact, not only are they not the best investment, the whole concept that was created around them is, in my opinion, wrong and dangerous, but this took me years to understand and internalize. However, you don't have to spend years to do the same, because I will explain it to you right now. The first issue is that there is only one filter. The company has to raise the dividend. It doesn't say how much. So in theory, if a member of the S&P 500 raises its dividend by 1 cent for 25 years, the stock will be considered a dividend aristocrat. And if any public company that is not even a member of the S&P 500 raises it by 1 cent for 50 years, it will become part of the even more prestigious group of the Dividend Kings. Now, as you might be guessing by now, that creates a certain problem. Companies are able to game the system by raising their dividend with a penny simply to keep their dividend king or aristocrat status. In fact, I have actually said before in my videos, and have been proven right eventually, that if a company starts doing that, it's actually one of the red flags you need to watch out for. If that starts to happen, usually it will mean the management is desperately trying to hang on to the status the company has, but the financial situation is so bad that they simply can't afford anything else than a few cents. And this leads me to the next issue. If the financial situation has not deteriorated that much, and yet is still pretty bad, but it allows the management to maintain healthy dividend growth percentages, this is actually a big problem as well. They are prioritizing dividend payments just to keep the dividend aristocrat or king status instead of simply telling investors they will need to lower the dividend a bit so that they can fix an issue with the company. This puts unnecessary pressure on the management to maintain a dividend when they should have used the cash flow to deal with an issue or to pursue a growth opportunity within the business. And so, yes, to some extent, the king or aristocrat status might bring them new investors and inclusion in certain ETFs, but this will be more than offset by the bad financial decisions made just for the sake of an artificial king or aristocrat status. And so, as a result, the financials of the company might deteriorate. And that brings me to the third issue, which is the lack of other quality filters applied to these two lists of companies. As I already said, the fact that a stock has increased its dividend is good, but it's only a small part of the picture. The Dividend Aristocrats list would have been much more useful if there was, let's say, a rule that says the dividend payout ratio cannot go above 70%. The dividend payout ratio is a metric that measures what percentage of the profit of the company goes towards dividends. So if the Dividend Aristocrats were companies that have raised their dividends for 25 years and at the same time had dividend payout ratios below 70%, this would make the list much more interesting. or something else, just something that measures a level of financial strength and health, not simple 1 cent dividend increase. Alright, because I don't want to leave you just with dry theory, I will now give you a few examples of dividend kings and aristocrats which have fallen off their throne and have cut their dividend. The first one is General Electric. The company was incorporated in 1892 and was known as a reliable dividend payer for many decades. However, when the financial crisis hit, the company severely slashed its dividend. Then it started going back up again, and they slashed it one more time, completely destroying their image of a reliable dividend payer. The next example is AT&T, the former favorite dividend stock of everyone. The communications giant had increased its dividend for 35 years straight, and investors loved the stock for its perceived secure, reliable, and rising dividend. However, due to too much debt and other issues in 2022, it cut its dividend by 22%. And in the next year, the cut was followed by another one. The company that was one of the largest and most secure stocks and the leader in the communications sector fell way behind companies like Meta and Alphabet because it couldn't innovate enough and had too much debt. And as a result, investors who relied simply on its dividend history and status suffered. Our next dividend aristocrat that fell from its aristocratic status is Walgreens, the giant retail pharmacy chain. The company had raised its dividend for 47 years, being 3 years away from becoming a dividend king. All new investors who were attracted to the stock because of this stellar record were shocked when the company cut its dividend by a half couple of months ago. Of course, anyone who bothered to look at the fundamentals and beyond its status as an aristocrat could see the obvious signs. I even remember researching the stock when I was wondering whether I should add it to my portfolio years ago. What stopped me were the deteriorating fundamentals and the fierce competition from online drug delivery companies, particularly Amazon. As a result, I saved myself a lot of pain. The lesson here is that investing is like driving. It's good and even necessary to look at the rearview mirror in order to know what the situation on the road behind you is, but you never drive by only looking at it because you will most likely crash pretty fast. The situation was the same with Walgreens. The company had a recession-resistant business model because people always need to buy medicine regardless of the economic conditions. However, they could not adapt fast enough to the changes in the business landscape, and as a result, anyone investing there got burned. So now let's proceed with two examples of dividend kings which have fallen from their throne. The first one is VF Corp, which had just achieved the status of the king, but it was short-lived. The huge apparel manufacturer cut its dividend in 2023 with 70%. As with a lot of examples we already had, the company had too much debt. The maker of North Face jackets, Vans shoes, and other iconic brands had seen its cash flow weaken after pandemic-related supply chain challenges led to management ordering too much inventory, just as consumer spending shifted from goods to experiences and services. This pressured the company to cut its dividend after 50 years of raises, sending shockwaves throughout the dividend investing community. And the second dividend king to lose its crown, which I will give as an example, is Leggett & Platt. The home furniture manufacturer had paid rising dividends for over 5 decades and was loved by dividend investors. However, after slowing sales and a huge debt load, the company announced 89% dividend cut and lost its dividend king status. If you're paying attention, you will probably start seeing a pattern. Old companies with high debt loads, which are struggling to adjust to the new realities and shocks we have had in recent years. Now, don't get me wrong, old doesn't necessarily mean bad, as there are other examples of kings and aristocrats like Procter & Gamble and Coca-Cola, which continue to innovate, manage their debt properly, and stay relevant. But this is the key. You have to be able to differentiate and never use only the aristocrat or king status as a guideline. This is why, unlike at the start of my investing career, I have shifted away from using this status as a filter and only view it as a nice bonus to my companies, nothing more. If you want to see my current top 4 stocks and ETFs I invest in for the current environment we are in, you can go to the link in the description. The report is free, it will be sent directly to your email and will be up to date regardless of when you are watching this because I'm constantly updating it. So what is the big lesson here? Well, if you have been investing even for a few weeks, you would have likely read the phrase that past performance is not a guarantee of future results. While that's true in general, I feel like this phrase was specifically created for the case with dividend aristocrats and kings. As I said already, looking at the rearview mirror is useful to get your surroundings right, but looking only at it will get you in a terrible car crash. So what should you do instead? As a start, take my advice and start treating the king or aristocrat status as a bonus rather than a main filter. When you see a sound company with great financials, responsible management, great future, and on top of that they have paid a rising dividend for 50 years, then yes, of course, this is a good sign. It's a sign of prudent management planning and a company that consistently rewards its shareholders. But you need to focus on other things like the payout ratio, the free cash flow, the efficiency of the capital, the margin of the business, the competitive mode, the debt compared to their assets, how much is their income covering their debt payments, and a lot of other stuff that I cover in my dividend method program. If you want help with that, you can find the link in the description to join, and I will walk you step by step through how to evaluate a company's health and future prospects. Without doing that, you're setting yourself up for an eventual failure when, just like in the previous examples, the smart investors have already left the boat and you are left holding the bag, shocked about your beloved dividend king eliminating its dividend. Now, since some of you might say that instead of holding individual dividend aristocrats, you can buy the Dividend Aristocrat ETF, I wanted to briefly share my thoughts on that. The Dividend Aristocrat ETF is the ProShares S&P 500 Dividend Aristocrats ETF, ticker symbol NOBL, pronounced noble, because, you know, the aristocrats are noble. Yeah. This ETF has all the current aristocrats and was created in 2013. If you invest in it, you certainly mitigate part of the issues we talked about this far, since even if one or two companies cut their dividend, the other 60 in the ETF will keep going. However, the issue here is that this might lead to constant underperformance because of the churning of companies. Since the goal of the ETF is to give you appreciating dividends from companies that raised them for decades, I will compare it with two other famous dividend ETFs created for that purpose: VIG, the Vanguard Dividend Appreciation Index Fund, and DGRO, the iShares Core Dividend Growth ETF. Let's start with the yield. Noble has a yield of 2.08% currently. The Vanguard Dividend Appreciation ETF's yield is 1.82%, and DGRO is currently yielding 2.35%. So the winner here clearly is DGRO. Now, let's check the total returns of the funds and compare them to each other. As you can see, the Aristocrat ETF is the clear loser here, trailing the other two with 20%. It's hard to say which one is the winner because the difference between DGRO and VIG is only 2%, which for a cumulative performance for 10 years is nothing, so I will consider them equal here. Next, let's see the most important part of the ETFs that price themselves on dividend growth, the dividend growth rate. Noble's dividend growth rate is 20.5% for the past 10 years, 7 for the past 5 for the past 3, and 16 for the past 12 months. For VIG, it is 8.5 for the past 10 and 5, 11 for the past 3, and 6.6 for the past 12 months. For DGRO, it is just about to reach its 10-year anniversary, so it has no data, but for the past 5, it's almost 10, then 8 for the past 3, and 10 again for the past 12 months. So, looking at those results, in my opinion, it is pretty hard to judge the winner. Each ETF has outperformed the other for different periods. I would say based on the huge 20% 10-year growth rate for Noble and the big 16% increase for the past 12 months, that it is the winner. But you can see a decline in the 5 and 3-year range, where it is losing to both the others. And actually, for the past 12-month increase, I have my reservations because if you look at the history, it actually cut its dividend in 2022 and then increased it back again the next year. If this was a one-time occurrence, it would be okay. But for the short history of the ETF, it has actually done it 3 times, which is not supposed to happen for an ETF having only the supposed cream of the crop of dividend growers, right? Why is that? Well, because at the same periods, the ETF has had one of the big dividend aristocrats at the top, and when it slashed its dividend, this dragged down the whole ETF result with it. If we compare that with VIG, it has also had minor cuts right in the financial crisis in 2009 and also in 2013, but hasn't had one for the past 10 years. And this is unlike the DGRO, which for the past 9 years of history hasn't cut its dividend at all. Now, I'm not quick to declare DGRO the winner here because it wasn't around in the financial crisis in 2008 when VIG suffered a cut, but I would prefer one of the two for sure instead of the Noble one. Which is weird because the goal of the Snowball ETF is to have companies that don't cut its dividend, right? But as we can see, this is not the case. And last, but also very important, let's look at the compositions of the funds, something which I always like to look at because it gives me great idea what the results of the filters are and what to expect. For the Snowball ETF, you can see that half of it is in industrials and consumer staples, which is to be expected, having in mind that not a lot of tech companies were around, let alone raising dividends 25 years ago. I like these sectors, the industrial because of the onshoring trend in the USA, and the consumer defensive because it gives stability to the portfolio. So I'm okay with that. However, I don't like the fact that the filter of 25-year dividend growth doesn't allow the ETF to include the biggest and best companies of today. We can see that by looking at the top 10 ones. Now, compare that to VIG's top 10 holdings, which are all powerhouses: Microsoft, Apple, Broadcom, Chase, Exxon, United Health, Visa, MasterCard, Home Depot, Procter & Gamble. I feel much more comfortable in these names than in the previous ones. The sectors for VIG are a standard picture for all the big ETFs right now, from what I have seen, with tech, financials, and healthcare as the top three. And as I said, is typical for the current situation with big dividend ETFs, the same are the top three sectors for DGRO as well. The top 10 holdings for it are Exxon, Chevron, Apple, Microsoft, Chase, Johnson & Johnson, AbbVie, Broadcom, Procter & Gamble, and Merck. So when it comes to the stocks and sectors comparison, I'm not sure I can definitively choose between VIG and DGRO, but I would definitely not choose Snowball. And so, as you can see, if you really want to invest in the Dividend Aristocrats, in my opinion, it will be far wiser to do it through the ETF. However, compared to those two ETFs, which basically were created for the same goal, I'm not sure why a person would choose the Aristocrats over the other two. So let me know in the comments what do you think about the Dividend Aristocrats and if that video helped clarify their issues for you. Also, since I mentioned DGRO, make sure you check this video I did on the ETF. It is a deep dive analysis that will show you everything you need to know if you decide to invest in this dividend growth fund. I will see you there.